In 2020, the world collectively saw a once-in-a-lifetime event which no economic guru could have ever predicted: the pandemic. Nobody would have thought that a mishap in Wuhan would have consequences for the entire world. It would have us sitting tight in our homes, hiding from an invisible force, and little did we know that every 6 months afterwards, we'd be dealing with another wave on top of that. Unfortunately, we have all seen the horrors of the pandemic in the last 2 years and have suffered either financial or personal losses because of these horrors. As they say, the market is usually the collective reflection of the people, and currently, owing to the weird times we live in, the markets too have most definitely been vague, volatile, and unpredictable. As workplaces shut down across the world and we sat at home, there have been tectonic shifts in the real estate market in the United States. You can check out my video on how housing prices in the US have witnessed obnoxious inflation and how day by day it is getting almost impossible to buy a home in certain neighborhoods. Why did this happen? Because the government wanted to incentivize people to borrow and spend. They implemented monetary measures like quantitative easing, low interest rates, and they printed money. But in the real world, sweet turns sour before you know it. This prolonged and loose monetary policy has reduced the buying power of the dollar, and the economy seems to be hanging by the skin of its teeth. With inflation touching a horrifying 7% in the country, according to the Fed's already doctored CPI figures, and in real terms, it's sitting above 10% now. There's no doubt that life decisions are much harder to comprehend with the looming pandemic, but as a responsible and smart investor, it's also our duty to understand and learn from the best in the game about how the current economic climate works, and more importantly, how to make our money work for us. So today we're going to hear from the almanac of the investing world, the founder and co-chief investment officer of one of Wall Street's alpha hedge funds, Bridgewater Associates, and Ray Dalio. Why him? Well, that's because lately, Dalio has been making some serious claims about the US economy and it's not looking rosy. But there is one major caveat here, and that is Ray Dalio himself and my problems with who he is as a person, but we'll save that for later. Really quickly though, make sure to leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts for all my own investments.
We've all been trying to make sense this morning, as we do every morning, of where we are in this economy and where we are in the markets. And I haven't had an opportunity to hear from you and ask you where you think things stand right about now. I know you always think about things sort of in the machine, the economic machine. So help us understand what's going on inside Ray Dalio's mind right now.
Well, I think it depends on the time frame, and I think the relevant time frame is the next few years. And I think you have to put things in the context. So there are three big forces that have been at work, and I think you have to understand those. First is the debt money thing. How much debt and money, and what are the repercussions? How does that pass through the economy? What does that mean for markets, inflation, and so on? We're in a different era now. Zero interest rates, produce a lot of debt and monetize it. Second influence, the conflict, internal conflict over wealth, left-right conflict, that conflict. And then the third is the rising of a great power in the form of China, challenging an existing great power and challenging the existing world order. Those three things are coming together at the same time as then we have a pandemic. So I think each one of those is a cycle. What's happening now has not happened before in our lifetimes, but has happened in the 1930 to 45 period. I went back and studied it over 500 years, and so it's that context. So I think if we're talking about anything, we should look at that within that context.
Okay, let's break it down then, and let's start with the debt situation that we have in this country, and the zero interest rates. Given you're a student of history, what happens next?
There's not enough money to go around, right? We're spending a lot more than we're earning, and we have to do that partially because of this social redistribution, that necessity, and they can't take it all from taxes. And what that means is the printing of money. So it's the mechanics of that. So what you do is you get more money, and so that devalues the value of money. In other words, cash is trash.
You came on our air, I think, in Davos and said cash is trash. You still believe it?
Of course you don't. Look, this is guaranteed. you are not going to have an interest rate that's going to compensate you anywhere for inflation. So you have to look at the cost of the money, right? And so that interest rate, whether it's the bond rate or whether it's the cash rate, certainly, you're not going to get that. And so we have this wonderful sugar high, which is to distribute the checks and so on. But that means everything else goes up in relationship to cash because it's better to borrow cash. That's just mechanics. So we have that dynamic underway. So we produce inflation. But what you do know is that interest rates must be below inflation rates and must be below the nominal growth rate in order to deal with all of that debt in order to finance it. And that depreciates the value of cash and money. So you have to invest it elsewhere. That's the dynamic, right?
We're hearing the fears of yet another economic downturn from one of the most legendary investors in the world, a man who has written an entire thesis on big debt management in one of his best-selling books. This is a man who, in 2008, met with US Treasury Department staff and other White House economic advisors months before the financial crisis to discuss the alarming concerns of growing financial leverage in the economy, and he was largely ignored. His firm, Bridgewater Associates, the largest hedge fund in the world with assets under management of $225 billion, employs deep analysis and pattern association techniques to forecast and allocate money. The fund and Dalio himself make billions of dollars off a top-down economic strategy by gauging changing climates better than anyone else. So much so that the firm has earned a reputation of being a global macro firm as well. Their investment thesis is heavily reliant on economic trends such as exchange rates, inflation, and GDP growth. In fact, this very research methodology eventually helped Bridgewater mitigate much of the 2008 stock market crash for its investors. In a year which was disastrous for many of Bridgewater's rivals and by and large the entire world, the firm's flagship Pure Alpha fund rose in value by 9.5% in 2008, while the market as a whole fell by over 35%. Today, it almost feels like another frantic Dalio, trying to send us all a message, but the crisis is again looking like it's just going to be swept under the carpet to be dealt with another time. He claims that the macroeconomic weather suggests that we're heading towards something catastrophic, a trend similar to what he witnessed before the housing market crisis in the noughties. We all know how borrowing had spiraled back in the day. The central bank was forced to print large volumes of money in order to provide stimulus and revive the economy. Well, Dalio didn't bite the bait back then either. He made himself serious money as he bought gold and other commodities, went long on treasury bonds, and shorted the dollar. Now again, after 13 years, it looks like he's screaming that the fire has been rekindled, which means the smoke will rise and that people will panic when things start to go south. If you've made it this far into this video, it means you're probably eager to learn more about how to be responsible with your money. Dalio says cash is trash, and with inflation as high as it is, it's hard to disagree with him. In a recent interview with CNBC, he said, and I quote, "Diversify across countries, currencies, asset classes, and so on, so you have that balance. You can take your tactical moves from there. All those asset classes will outperform cash." Now, cash may be king, but Dalio warns of the cancerous effect of holding cash. And why is that? Well, let's hear it from the man himself, but first, a quick message from this video's sponsor, Vaulted. Now, if you're like me, you're worried about inflation and thinking about diversifying your portfolio with gold, Vaulted is the best way for individual or even institutional investors to acquire physical gold with a great website and mobile app that makes it easier than ever before. They store and insure their gold in the Royal Canadian Mint. It's all real one-to-one allocated gold manufactured by the Royal Canadian Mint and certified conflict-free, meaning that you can rest easy in the knowledge that you can request instant physical delivery of your gold holdings whenever or wherever you desire. Their prices are the best in the market because they store all their gold at the manufacturer, the Royal Canadian Mint, and they cut out all unnecessary middlemen. They don't charge any premium or spread when buying or selling you gold, and they are as transparent as possible, meaning there are absolutely no hidden fees. On top of all that, they even manage to put out some great articles to keep you updated on the investing world. Now, if that sounds at all interesting to you, if diversifying your portfolio is important to you, then I highly suggest you check Vaulted out. There's a link for you down below in the description and in the comments section for you to check out.
Cash is trash, okay? Cash is that they're going to, because they're going to print money. What do? You get out. Okay, so cash is not going to be
So what
good.
do you do?
So what you have to do is you have to have a well-diversified portfolio. First of all, you have to be global, and you have to have balance. And I think you know, I don't want to grab, well, the headline's going to be, they give them anyway, is I think that you have to have a certain amount of gold in your portfolio, or you have to have something that's hard. There are three monetary systems that happen. The first is, in the old days, it had intrinsic value. You'd carry around gold coins. Then we come up with the idea of banks or even central banks. And what they do is they create certificates, we call notes, that are claims on those things. And we print many more certificates than there is money in the bank. And then that's a linked system. And so we did that, and we broke that in 1971. Then you have a fiat monetary system, which means that you can print whatever amount of money you want, and you can put that, and that's what governments do. So we're in that part of the cycle, bigger picture, so that when you think about things, the depreciation of the exchange rate and the printing of money, I think over the next few years is going to be the biggest.
If you want to buy gold, do you buy Bitcoin?
No, there are two purposes of money: a medium of exchange and a storehold of wealth. And Bitcoin is not effective in either of those cases now.
Store of wealth?
No, because first
potentially.
Of all, it's too volatile. Because of the volatility, you can't go next to it. Someday when it, you know, I would say Libra or something which has more stable value, has got more potential. But also, who's going to do the buying? Central bankers and others. What are they going to hold as reserves? What has been tried and true? Are they going to hold digital Bitcoin? They're going to hold gold. That is a reserve currency, and it's been a reserve currency for 1,000 years. I know this is going to be the headline of gold. I want to emphasize a bit of gold is a diversifier, okay? And that's the advice I can give. I know I'm going to come out of here like Ray Dalio's Wild on Gold, and that's not exactly.
I'm going to say cash is trash is your headline.
But cash is trash.
But Ray, you would have thought that after all the years of zero interest rates in QE 1, 2, 3, and 4, you could have been making this case that entire time of what you were just making. Maybe there was so much of a lack of demand in the private sector following the financial crisis that it was able to absorb all of that. But coming to us now with that, it at the risk of sounding like the boy who cried wolf too many times, I'm not saying you did, but we all were, the death of the bond vigilante, it's been well documented for the past 10 years. Now you're saying is the time to work.
I think it's totally different. Well, I would say when we are dealing with the negative interest rates,
which we've had for years and years already.
Well, no, we know how long it's been. Okay, and you take each country, and you take where we were in December toward the tightening, then you create an easing. We are now coming into a direction. And so the question for any of us is not whether it's early or not. The question for any of us is when you're holding all of those bonds and you have a negative interest rate or something, and how far more can you push that? What does the next 5 years look like? And the next 5 years is going to be something like that, plus there'll be more deficits. Now, more deficits means sell more bonds. Who are you going to sell the bonds
Why
to?
should I believe we're going to negative interest rates in the United States?
Well, I think that, and I'm not saying now, I'm saying that, okay, if you have a next downturn, okay, it's on average 500 basis points of rate cuts. Oh, then you can't do that. You go to QE, right?
Right.
And
we're having trouble normalizing.
Stimulant,
right.
We don't have much stimulant. We have people at each other's throats over the wealth gap. And so what will the next downturn be? And also, why would you want to hold those? Why do you want to hold those at some point? I don't know. I could be wrong. I've been wrong plenty in my life. So I could be wrong. I'm just trying to describe, tell me why that makes sense.
With the cost of money negative and below the nominal growth rate, borrowing and investing in anything that can grow at or above the inflation rate is tremendously advantageous, and that's what the markets are currently pricing in. Now, it is imperative to understand why cash is trash, and for that, we need to fully digest the fact that inflation is at an alarming 40-year high in the United States. As a result of this, borrowing today is essentially free. Right now, if you take out debt, you will pay almost no interest and can defer principal payments, making credit available at quite literally zero cost. When countries require more money and have no other options, history shows that they will produce more money to disguise a failed monetary policy, like the Fed is doing today. It's an eyewash for the general public. Printing money doesn't deprive anyone of their hard-earned cash physically, making it politically easier because it's an invisible tax. What does that mean? It means that idle cash that you're holding today is getting eroded away at a record rate. High rates of inflation make money less useful in many ways. Firstly, when inflation rates are high, the longer you hold money as cash, the more value you lose, so you spend it immediately rather than holding it. This stimulates spending, it stimulates growth, but if people see high rates of inflation and the rate of their transactions increases as a result, inflation will increase even further and it starts to spiral out of control. Secondly, if inflation rises to very high levels, money's usefulness as a unit of account diminishes. Simply put, you could buy 2 apples on $1 5 years ago, but now it buys you just 1. If prices are changing rapidly, communication between buyers and sellers becomes complicated, comparing prices becomes complex if all prices are rising rapidly, and your cash now starts to fail as a form of currency. Now, in a recent interview with MarketWatch, when Dalio was asked if US inflation is transitory, meaning if it's just a short-term affair and can be taken care of easily, he strongly disagreed and said something worrying, which is, there's 2 types of inflation. One is when the demand for goods and services rises against the capacity to produce them. That's normal, cyclical inflation. But then there's the second one, monetary inflation, the creation of a lot of money and credit relative to the quantity of goods and services, and the US right now is seeing both. He goes on to say that when he looks at the country's financials going forward, what the size of the deficit will be and how much money is produced, that's a concern. There's also the risk or even the probability that those who are holding cash and bonds will choose to sell those to move into other things. If that happens, the US central bank will have to decide if it raises interest rates, which will hurt the economy, and I don't believe that they can do that in a significant way. It would be bad for the economy, politics, and the markets if they tried to rectify that by allowing interest rates to rise, so they're probably going to have to print more money, and that causes more monetary inflation. Currently, it looks like everyone can see the problem, but few can see the remedy. Recently, Chairman Jerome Powell claimed that the economy is healthy but requires monetary policy tightening due to a transitory inflation surge. Contrary to that, we have stalwarts like Dalio looking straight into our eyes and telling us that we are fools and that the Fed is trying to downplay a major economic problem. It's tricky because it seems like the Federal Reserve in particular is caught between a rock and a hard place. They need to tighten their policy to keep inflation in check, but doing so will harm the economy. From the outside, it looks like the next 2 years could be a major test for Powell and the team. It's never an easy balancing act when the stakes are so massive. The science of economics agrees that the quality of monetary policy can make or break a country, but how that transpires is yet to be discovered. One can only imagine what that would mean from a political standpoint, when people are at odds with one another, when they thought that they got rich but it was all only notional, the rose-tinted glasses will come off, minds will jolt at the last minute when they see the downturn around the corner. I cannot stress this enough, but the toughest piece of the puzzle as of today is that you cannot raise interest rates high enough to make a difference. Interest rates must be well below the rate of inflation as well as the rate of nominal GDP growth to sustain this type of economy. What we can infer from the news is that understanding the situation and preparation is key. Dalio states that he's been wrong before too, but future catastrophes are inevitable, and as they say, things only make sense in retrospect, but it's paramount to be ready no matter what. For the United States, cyclical and monetary inflation are the elephants in the room. The trade tiff with China isn't improving anytime soon. The massive real estate bubble brewing will take its own sweet time to settle. It's never a bad idea to diversify. Sustained and consistent gains are better than reckless investments leading to nothing. Remember to not keep all your eggs in one basket. Be careful about holding cash. Over a long enough time frame, it's always a losing strategy. Now, as for Dalio himself, I've made no secret of the fact that I'm not a fan, and that's something that really is a shame for me to have to say. By all accounts, when it comes to investing, running a business and building a hedge fund, when it comes to macroeconomics, he is without a doubt an incredibly talented man. His record speaks for himself, and I don't doubt at all that I will never match up to him as an investor. But my problems with Dalio aren't about how much money he returns to his clients. My problems with him are about his failures to stand up to evil. His failures to stand against the erosion of human rights in Hong Kong, Xinjiang, and Tibet. His failure to put human life above money. His failure to act as a decent, compassionate human being. Dalio may be a successful investor. He may be a billionaire and the founder of the largest hedge fund in the world, but that will not be his legacy. His legacy will be clouded by his atrocious record when it comes to morality and integrity. As a human being, he has failed in the only reason any of us even exist here on Earth, to leave our planet in a better state than we found it. Now that is it for the day, and I apologize if that bit at the end wasn't what you wanted to hear, but it needs to be said. Evil needs to be opposed at every possible opportunity, and we can each do so in our own ways. I'm fortunate enough that I have this platform that allows me to speak about this publicly, and for that, I am truly grateful to each and every one of you for the support you have shown and the part that you've played in building Stoic Finance up to what it is today. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to Masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.